Okay, so for today's agenda, it'll be pretty simple. We'll be mainly talking on gold based on technical analysis, and after which we'll talk a little bit on NVIDIA Corporation on the trading note that we recently published. So without further ado, let's dive straight into it. Standard disclaimer. Probably I'll do another sound check. Is everyone hearing me loud and clear? If so, please type something into the chat box so I can check it again. Is it okay? Okay, I'm seeing good response. Okay. Alright, then I'll continue from where I left off. Thank you guys. So like I mentioned, for today's main course will be on gold and silver. And what we are seeing in gold and silver is we believe that inflation and uncertainty will be the main theme in 2017 that will drive gold and silver prices higher moving forward. Not just in 2017, but probably in 2018 and 2019. And we'll dive a lot deeper into why we believe inflation and uncertainty will sort of take hold within 2017 and onwards. So before we start proper, I'll just give you a quick update on the year-to-date performance on various asset classes. So here is the asset classes performance of precious metal, gold and silver in comparison with the US equity market, basically NASDAQ Composite, the S&P 500 as well as the Dow Jones Industrial Average. So you can see over here, since the start of this year, sort of a gold and silver has been outperforming the equity market as a whole. Even until last Friday, this is the year-to-date performance as of last Friday's closing, 24th March. You can see the closing performance was silver was up around 12%, gold was up around 8%, followed by NASDAQ at 7.3%, S&P 500 at 3.8%, and lastly Dow Jones Industrial Average at 3.5%. So there seems to be some sort of an anomaly happening right now within the performance of these asset classes. Usually when we see risk-on kind of environment between the equity markets, usually we don't see silver and gold sort of performing in the same kind of direction. What's happening right now is you can see across board, precious metal as well as the US equity market as a whole has been rising from the start of the year and has continued to sort of stay within this upward trend. We believe what's happening right now is market participants are sort of pricing in a higher inflationary pressure that's going to come into the market, which is why we see an upbeat move between the precious metal as an inflation hedge from the start of the year. Moving forward, reason more in terms of why we believe inflation is going to sort of brawl back into the market from here on. And right now we just dive straight into the main part that we believe why gold is sort of a next big play moving forward. So I've shown this chart before, for me last year, beginning of the year. This is the 8-year cyclical bottom kind of a chart. So this is a long-term view on gold, dating all the way back to 1970s. I've demarcated the vertical line over there, which sort of annotates the cyclical bottom of each cycles. And as you can see over here, gold sort of follows this kind of 8-year cyclical bottom pattern, whereby every single time when it hits a cyclical bottom at the 8-year time period, it moves ahead with a new strong bull market. So what I mean by that, probably I'll just illustrate with a few examples over here. So the first cyclical bottom was formed around in 1976, as you can see over here, and it took the market around 8 years, 6 months before it found its next cyclical bottom, before the market goes ahead and moves into a bull market. So the next cycle took exactly 8 years again to form at around February of 1993, where the cyclical bottom was formed, and subsequently you can see a bull market sort of takes over. Same thing again, 8 years, 1 month later, another cyclical bottom appeared in around March of 2001, and as you can see over there, usually when a cyclical bottom sort of fixes itself and a bull market takes over, the bull market sort of takes over in a very roaring manner. And the one in 2001, you can see gold price actually rallied 305% during that cyclical bottom. And then the most recent one took around 7 years, 7 months to form in October of 2008. And as you can see over here, the rally was pretty strong again at 182%. So back then last year, beginning of last year, I think it was in January, where we came out with a report on this cycle bottom. We were looking at around May to October of 2016 last year to sort of find a cyclical bottom for gold. And right now, with benefit of hindsight, we believe that the December 2015 low at around 1046 pretty much is the cyclical bottom that have already been in place. And moving forward, just from a cycle point of view, we believe gold should continue to move in this upward trajectory kind of a manner. And we expect gold prices to continue to soar higher within this new circular bull market to take out its previous all-time high at 1920 level that was fixed in place back in 2011. And we also have expectations of price breaking through this 1920 level moving forward, like the rally that we have seen back in 2001 and 2008. To sort of couple the cycle pattern that's playing out, we look at the gold-silver ratio as well as sort of suggesting the same kind of a pattern playing out. So over here we have the gold-silver ratio at the bottom panel. For those that don't know what the gold-silver ratio is, basically it tells us how many ounces of silver can 1 ounce of gold buy. So for instance, the current gold-silver ratio stands at around 70, which means 1 ounce of gold can trade for around 70 ounces of silver. How we use this analysis is, as you can see, I've sort of demarcated a horizontal line over there that demarcates the 80 point, the 80 ratio of the gold-silver ratio. And what is happening over here is you can see whenever gold-silver ratio hits an extreme of 80 level and when it starts to revert to the mean, pretty much gold benefited nicely in a bull market. So this happened in around May of 2003 when we overshot the 80 extreme point in the gold-silver ratio. And once it subsides to a normal level, you can see subsequently gold appreciated 200%. Same thing happened in November of 2008, whereby the gold-silver ratio sort of stretched over the 80 level extreme point. You can see gold subsequently appreciated 170%. So most recently in Feb of 2016, similar pattern play out again. We sort of overshot the 80 extreme level, hitting a high of I think around 83. And since then, you can see the gold-silver ratio is sort of reverting back to the mean. And we believe that this downtrend of the 80 points should continue, and that should easily drive gold prices higher in line with the 8-year cyclical pattern that's suggesting the 1920 high in gold. After covering the two sort of main point, the main key charts that sort of makes us believe that gold and silver is ready to go into a whole new bull market, we sort of dive into other fundamental catalysts that we think will drive gold and silver prices higher moving forward from here. So there will be three key points that we believe will be the catalysts. So number one will be rising inflation, which we'll touch a lot more in a further slide. And point two will be US political gridlock. So for those that haven't been following the US market as normal, what happened on Friday is you see President Trump actually failed to pass the repeal and replacement bill of the Affordable Care Act due to the fact whereby he lacked Republicans' votes to actually pass the Affordable Care Act Repeal and Replacement Act. So with so much delay and postponement from the passing of bill, Trump also failed to actually pass this particular bill. We believe it will sort of bring more uncertainties in terms of pushing the other policies that's going to be promised by him, more so in terms of tax cuts as well as infrastructure spending. So these two particular policies that Trump has sort of promised, and which is what the market is hyping on since election day, we believe tax cuts won't be enacted as soon as 2018, and infrastructure won't come into play until 2019, 2 years later. So these two big question marks remain a big point whereby volatility is going to kick in when we sort of get more certainty whereby there isn't any much clue of what's really going on in terms of tax cuts and infrastructure spending. Moreover, there is also the debt ceiling problem that is sort of hampering the market right now. So debt ceiling was sort of slapped back in place 2 weeks ago at 20 trillion, which means the government can no longer borrow more money until they sort of pass a bill to suspend or raise the debt ceiling. So same thing over here with the failure to pass the bill on repeal and replacement bill on the Affordable Care Act. There's a high chance that we will see more delay in terms of passing the bill on tax cut infrastructure spending, as well as the suspension or the raising of the debt ceiling moving forward. So all of these things within the US political landscape should sort of bring more uncertainty as well as volatility into the market, which would then be sort of beneficial for gold as a safe haven play. Moreover, in terms of other countries, in EU there is also other political uncertainties such as the election in France that's going to come out very soon next month. followed by a Germany election in September. So what I mean by inflation, right now we'll just dive straight into inflation. So here's a chart that shows various indicators of inflation. The main point over here to highlight is the one in turquoise line as well as the one in pink. The one in turquoise is the consumer price index, X energy and food, as well as the pink one, which is consumer price index headline number. Both of these headline and consumer price index, X food and energy, has already way surpassed the Fed 2% mandated level of inflation. So what I mean by that is consumer price index, X food and energy, has already been above the 2% level for the past 15 months, as well as the headline number has been above the 2% mark for the past 3 months. So all in all, you can see inflationary data has been actually moving to the upside all the way since October of 2015. And the other indicators that I've overlaid here is sort of import prices, producer purchasing price index, as well as personal consumption expenditure. So the Fed's preferred inflation indicator is the PCE, shown by the orange line. It's currently hovering at 1.73%. So it's also sort of very near the 2% mark that the Fed is looking out for. So all in all, we believe inflation moving forward from here on, we believe it's still going to continue with this elevated uptrend. And why so is because of the base effect that's coming from oil. For those who don't know, oil hit a low last year in February of 2016 at around $27 each level. And the average price of oil for last year was around $40 to $43. So where we are right now in terms of oil, for 2017, oil hit a high of around $55. And right now oil is trading around at 47, 48 level. So all in all, just based on the base effect that's coming out from oil, we believe inflation is going to stay elevated at least for the year of 2017. Like I mentioned just now, the European political climate. So here's a brief timeline on the European election. So 15 March have passed. 2 weeks ago, we had the Netherlands election. Pretty much nothing much happened over there. Non-event. But the big thing that's going to come will be soon in April and May, whereby we have the French election. So on 23rd April, there will be the first round of the French election, where polls are showing that Marine Le Pen is going to win. And then subsequently, the second and final round of the election is going to happen on 7 May, where polls are showing that there will be a head-to-head fight between Macron and Le Pen. But polls are showing that Le Pen will lose drastically as opposed to Macron. And keep that in mind, what we saw last year where the poll shows pretty much unexpected things happen. For example, Brexit as well as Trump victory. So take a pinch of salt in terms of what the polls are showing. So French election is going to be, I think, the next big thing that's going to happen in the market, whereby volatility is going to kick in. And then again in September of 24th, there will be the German election. So in terms of gold performing as a safe haven play over here, we believe gold is going to sort of experience some sort of a tailwind from this volatility event. To sum it up in terms of the economic policy uncertainty, it's pretty nicely summed up within this indicator over here at the lower panel, the Global Economic Policy Uncertainty Index, shown in the turquoise line. There's sort of an extreme level over here around 185 points. And as you can see, every single time when we breaches these 185 points, it sort of demarcates some sort of a panic turmoil period. So for instance, in 2001, that was 9/11 attack. You can see the index actually surpassed the 185 level points. What happened to gold, you can see, is gold acted pretty nicely as a safe haven asset. During that time, gold appreciated 33%. Same thing in 2003 where we had the Iraq war, gold appreciated 117%. The most recent one that I think everyone can relate to will be the subprime crisis. Same thing over there, when we reached this 185 level point, it suggests that we are in some sort of a market turmoil. Same thing over here, gold acted as a safe haven play again and gaining 165%. That's only in 2011, in the depths of the European debt crisis, when the index actually surpassed this 185 level point, it sort of failed for gold to perform as a safe haven asset. And instead, that particular point actually forms an all-time high in gold itself at 1920 level. So that by itself is an anomaly. But then again, bringing back us to the most recent market event in August of 2015, that was when the China yuan devaluation happened. Same thing, it spiked above the 185 level point, and you can see subsequently gold sort of appreciated 25%. So in terms of the current environment where we are right now, you can see the current index stands at 220. We believe it's an unprecedented level, way above the 185 points. And even before that, we have two other peaks due to the events such as Brexit as well as Trump's victory. So moving forward, we believe that the uncertainty will continue to stay elevated, at least for the foreseeable future, due to the two main points that I just mentioned, the US political gridlock, as well as the European political landscape whereby more elections is going to appear that are suggesting that people are steering towards the anti-establishment movement. So that by itself should give gold some sort of a tailwind again as a safe haven play, like I mentioned. And just to give you guys a feel of what really happened during some sort of a market event, this was a 5-minute time frame chart on gold, and this happened during Brexit. As you can see over here, when Brexit news started appearing on the headlines, gold appreciated 7.9% during that period, and silver at the same time appreciated 6.3%. And this is during US election where we got news of Trump winning the election. Same thing over here. Both gold and silver acted as a safe haven play, and gold appreciated 5.2%, followed by silver at 3.7%. So all in all, you can see how gold and silver sort of acts pretty nicely as a safe haven asset when unexpected thing happens. And like I mentioned, we believe that uncertainty should continue to stay elevated, at least for 2017, where volatility should kick in again when more uncertainty gets priced into the market. Right now, we'll just dive straight into explaining another component of inflation. So for this particular slide, I'll go a little bit slower because I think there's a lot of things to understand from this particular chart. So we have the Taylor rule, which is in white, as well as the Fed fund rate that is shown in orange. What the Taylor rule shows is sort of an economist's way of calculating an equilibrium level for the Fed funds rate based on two big components, inflation as well as output. So you can see over here, I've overlaid a bottom panel where it shows the spread between the Fed fund rate and the Taylor rule. And there's some sort of a correlation here is whenever we get a negative spread, some sort of a movement from negative to a positive spread has happened. And this particular motion is some sort of a market cycle whereby a negative will have to be followed by a positive and so on and so forth. So what it means is, maybe I just go through a few examples. Prior to 1972, you can see the spread was negative, shown by this highlighted area for 13 months, which means that the orange line, which is the Fed fund rate, is below the Taylor rule, the white color line. When that happens, you can see for a prolonged period of time when the spread is negative, it means that the Fed is way behind the curve in terms of chasing inflation. And when it gets out of whack, the Fed has no choice but to go ahead and start moving into a rate hike cycle. And as you can see, during that particular period prior to 1970, it took the Fed 13 months before they start raising rates from a low 3.5% to a high of 13%. And an observation that we noted is every single time when the Fed is behind the curve, they will overshoot the Taylor rule inferred interest rate and tend to overshoot it by a huge margin, shown by the positive spread over there. So the most extreme case happened in prior to 1976. You can see a total of 28 months before the Fed started to go about hiking interest rate. That particular move, the extreme point over there, the negative spread hit a low of around -6%, which means the Fed funds rate is below the Taylor inferred interest rate for 6%. And it took them around 28 months before they go about moving into a rate hike cycle. And as you can see over here in the 1976 rate hike cycle, that was the most drastic move in terms of a rate hike. The Fed actually hiked its interest rate from 4.75% to a high of 20%. And probably as we go through another example over here, prior to 2004, there was 36 months of negative spread before the Fed jumped in and hiked interest rate from 1% to 5.25%. So you can see the spread in terms of the Taylor rule and the Fed fund rate is a pretty good predictor for the Fed to actually hike their interest rate and where to take their interest rate to. The correlation back then was pretty positive from 1970s all the way until 2008. And only after subprime crisis, when the interest rate was left at 0.25% for a prolonged period of time, that was when the sort of correlation failed to come into the market again. But we noted something again recently, 2 years ago, December 2015, the Fed sort of were about hiking interest rate again. And we believe they are actually watching the Taylor rule, and they are sort of afraid that they are falling behind the curve in terms of chasing inflation. So the most recent rate hike in 2015, 2 years ago, it was actually 47 months of negative spread before they started hiking interest rate again, which was unprecedented. The longest period of time was the prior cycle, whereby it was only 36 months of negative spread. Right now, we are reaching an unprecedented level of 47 months of negative spread before they hike interest rate. So they are sort of worrying that inflation is going to pick up. And you can see in December 2015, they hiked interest rate once. However, they went very slowly and only hiked interest rate once more in a year's time later in December of 2016. It's only until recently whereby they realized that probably they are way behind the curve and they hiked interest rate once more in March of 2017 this year. So we believe that the rate hike cycle is going to be sort of aggressive moving forward. And if this sort of a Taylor rule model and the Fed funds rate holds true, then chances are that the Fed funds rate has to actually rise all the way to a high of the current Taylor rule level of 3.81%. And moving forward, like every single time in history, the Fed funds rate will definitely overshoot the Taylor rule inverted interest rate. So we believe moving forward, the Fed funds rate have to be above the current 3.8% level mark in order for them to curb inflation. And hence, you might wonder why I'm going through so much in terms of the Taylor rule and Fed funds rate. It's because look at the implication of rate hike cycle to go. Contrary to conventional wisdom, where a rate hike cycle usually depict a stronger dollar and hence at the same time will be very bad thing for gold. That's not true if the Fed is raising rates to chase inflation. So over here we have Fed funds rate shown in gold and Fed funds rate shown in orange and gold shown in the white line. I've demarcated the vertical lines. All the vertical lines are actually the rate hike cycle that is being forced by the Fed to actually chase inflation, shown by the previous slide over here from the Taylor rule. So you can see whenever the Fed chases inflation, so for example during 1972, you can see the rate hike cycle whereby the Fed raises interest rate from around 4.5% to 14%. You can see gold appreciated 256%. That is sort of against conventional wisdom, and especially the stuck rate hike cycle that happened in 76. That was when rates went up from 5% to a high of 20%. That huge jump in interest rate from conventional wisdom thinking would be that dollar would strengthen tremendously during that period, and that would cause gold to sell off pretty badly, but that is not the case as well. You can see over there during that rate hike cycle, gold appreciated sort of the largest margin, 401%. And probably I'll just go through another example in 2004 when the Fed started chasing inflation back in 2004 May period. They raised rates from 1% to the 5.25% mark. Just prior to subprime, you can see that particular aggressive rate hike cycle didn't really hamper demand for gold. So during that period, gold also actually appreciated 72%. So for instance, where we are right now, like I mentioned 2 years ago, December 2015 was the first time the Fed hiked its interest rate for a prolonged period of 8 years. And we have actually seen 3 rate hikes since then. We believe that the Taylor rule is telling us that the Fed is behind the curve in terms of chasing interest rate. And hence, this current rate hike cycle will be pretty much the same as these prior few interest rate hike cycles that we have seen, whereby gold should continue to appreciate in line with the rate hike cycle. And just to show you guys in terms of where the Fed is hiking interest rate in what kind of environment, we believe that the Fed is raising into weakness. And what we mean by that is you can see over here the orange line shows the Fed fund rate and the turquoise line shows the GDP on your chart. As you can see, I've highlighted the boxes over there. Prior to every rate hike cycle, the Fed tends to play on the safe side, and they only hike interest rate whereby the GDP is showing some sort of a strength. So you can see there is usually some sort of an uptick in the GDP on your chart first before the Fed goes about hiking interest rate. It happened in 71, in 1976, in 1983, in 1993, as well as the most recent one in 2004. there has to be some sort of a market recovery in terms of GDP on year growth trend first before the Fed goes about hiking interest rate. But you can see over here, the most recent one again, 2015 was when the Fed first hiked its interest rate. However, you look at the growth trend in the GDP on year sort of a chart. We saw a peak in GDP year on year in Q3 of 2015 at around 3.5%, and the current reading on the GDP year on year chart shows at 1.9%. Moreover, Atlanta Fed is sort of forecasting Q1 2017 GDP to come in at around 1%, which will make this growth trend look even weaker as compared to the previous few rate hike cycles that we have seen. So the implication of this is this will actually translate into a higher chance of us sort of slipping into a recession as the Fed raising the weakness, because the next chart will show you what I mean by that. So we have, again, the Fed funds rate shown in the orange line, and then the white line is the S&P 500, and the highlighted red regions are recessions. So you can see over here, demarcated at every end of the sort of a rate hike cycle, is usually being followed by some sort of market crisis event, as well as a sell-off in the equity market and recession. So probably I'll just go through what the chart is telling us. So you can see over here, during the rate hike cycle from 1970 to 1973-74 area, you can see when the Fed sort of stopped hiking interest rate and start to ease their interest rate policy, that sort of is a red flag that a market crisis is going to unfold. So back then, there was this 73-74 stock market crash, where the S&P sort of crumbled 41%. Same thing happened around in 1979. There was the Latin America debt crisis, and during that period, you can see the S&P slumped 22%. I'll just bring our attention to the two most recent examples that everyone can relate to. That was the dot-com and the subprime period. So you can see over here, the subprime crisis period is pretty similar to the previous few rate hike cycles, whereby once we see the end of the rate hike cycle and when the rate starts to plateau around the high, and once the rate starts renormalizing and starts to sort of fall, whereby it goes into an easing cycle, that depicts the end of the stock market bubble. So in 2000, that was the end of the dot-com bubble, whereby the market crumbled 46%, sort of being signaled by the Fed funds rate. And the same thing also happened again in the 2007-2008 period, whereby we have the subprime crisis. So interest rates stayed flat at 5.25% for a couple of months before they start easing, and that by itself suggests that the end of the rate hike cycle is here, and the Fed is moving into a sort of a panic mode. And moving forward, you can see once they start reducing interest rate, that is like the last nail to the coffin in terms of falling in the market bubble top. So in the subprime crisis period, you can see the market crumbled 52%. So we are currently moving in a whole new Fed hike cycle right now since 2015 December period. And like I say, since then we only have seen 3 rate hikes. So probably we are still too early in the rate hike cycle. But just one thing to note again is that in all previous rate hike cycles, it's all being done in the present view of that the GDP is actually strengthening. However, the current rate hike cycle is not something that is pretty optimistic. We are actually raising rates into weakness, which then gives us a higher chance of sort of flipping into a recession, like what we have seen in all previous examples over here. So moving forward, we would be pretty much keeping a close look in terms of what the Fed is doing to its interest rate. We believe that same thing over here, they will continue to sort of hike, at least for this year, chase inflation down. According to the dot plot, they're actually still seeing another 2 more hikes this year. So that should easily bring us to around 1.5% this year. And in terms of why we believe some sort of market correction is going to come, we've shown this I think a couple of times before. So here we have the table on the US economic expansion as well as the US economic contraction table. And what it's showing is that we are right now currently in the 3rd longest economic expansion in history, currently standing at 93 months. So we are definitely not in the beginning of this economic cycle, but actually at the end of the cycle, coming very close to the end of this cycle. The second longest one happened in 1968 for 107 months, and the longest one happened in 1991 for 119 months. So to put things in context, the current cycle is way longer than the one that we have seen back in 2001, just before subprime, at 73 months. And coupling with the current rate hike cycle, how it actually will topple the market into a sort of a market correction, as well as the economical growth cycle, currently the third longest. We believe the foreseeable future, once the Fed start to sort of stay flat and stay accommodative in terms of the Fed hike policy, that by itself should provide us with a pretty good red flag in terms of where the market should head to moving forward. And hence, with that, we believe with the higher probability of a recession or some sort of market crisis events is going to happen and unfold in the near future, gold should continue to sort of perform as a safe haven asset pretty well, like the previous few occasions. And here's the gold performance price chart that is for the most recent rate hike cycle. So we noted something interesting over here. So the orange line is the Fed fund rate and the gold line is the gold chart. What is shown over here, I've highlighted 2 points over here. This was the December 2015 first rate hike, and this over here is the December 2016 rate hike. You can see exactly 1 day after the Fed hike its interest rate, gold actually performed pretty well and rallied 29% and 11% respectively. This is sort of against conventional wisdom once again, whereby people are telling us that a rate hike cycle would be bad for the gold itself, at the same time be good for dollar, but this is not reflective of what is happening in reality. So there's some sort of a disconnect between the rate hike cycle to gold, and we believe again this is due to the fact whereby people are pricing in the higher inflationary forces that is sort of causing gold prices to benefit irregardless of the rate hike. So the most recent one we have seen over here, this is the March 15 rate hike again. Gold sort of bottom out nicely again on this particular rate hike, whereby the Fed increases interest rate from 0.75 to 1%. And hence, using this correlation play, we believe that at least in the short run, gold should continue to move in this upward trend and should easily go back to retest this 1370 July 2016 high. And here again, just to give you guys some information in terms of the timeline for our Fed rate hike. So this is a timeline over here. March is already over, whereby the Fed hikes interest rate. So all in all, the Fed meets only 8 times a year, and there's only 4 FOMC meetings that's being attached with conferences. And we believe that the Fed would play safe, at least for this year, to only sort of give some hope to the market that they won't hike during FOMC meetings with conferences. And that's going to happen in June, September, and December period shown by the red dots. So like I mentioned just now, the Fed projection dot plot is actually signaling still 2 more rate hikes this year, which will easily take us to 1.5%. So June and September looks pretty likely in terms of rate hike. And we are actually pushing the narrative that the Fed will actually force themselves to hike a third time this year to 1.75% because of inflation, as well as what the Taylor rule is showing us. And just based on market expectation, this is the probability that's being tabulated by Bloomberg based on options and futures pricing. So you can see over here, the market is also sort of pricing in a 53% chance as of last week of the Fed to hike in June again. So for this particular probability, anything more than 50% is actually a pretty good chance that the Fed will hike. So moving forward, we'll just continue to monitor what this particular probability will be. And as we get nearer to the occasion in June, probably we'll get more clarity in terms of whether the Fed will hike its interest rate. And now we'll just talk purely based on price action chart. So over here we have the monthly time frame chart on gold. What it's showing is that gold has actually experienced some sell-off in 2011, huge 45% sell-off since the top around 1920. But like I mentioned, from the cyclical chart, you can see over here, this point over here is the AL cyclical bottom that we mentioned in the first slide. It's sort of a form strong support of this 1044 level that was based back in 2010, 2009 period over there. And since then it has rebounded off pretty nicely. So in terms of some sort of a price action wise, the monthly bullish close we had last month, whereby we have a strong close above the 20-month moving average. That by itself is also showing some sort of sentiment change from this recent sell-off that we have seen. So we believe that gold should continue to move in this upward trajectory, as mentioned by the AS cycle as well as the gold silver ratio. And in terms of price target wise, we believe in the short run, gold should easily head back higher to test the 1370 to 1390 level. And subsequently after that, we believe gold could easily surpass this 1920 level that we are expecting price to hit. And since we're on the topic of price action, we noted something interesting as well on the dollar index. So for those that don't know, gold is denominated in dollar. So by looking at the dollar index, it also provides us with some sort of idea of where gold is heading into moving forward. So here's dollar index on a longer time frame chart. You can see over here, there's sort of a similar triple top pattern playing out right now that has happened back in 2001, 2002-ish period. So probably I'll just go through the triple top pattern back in 2000, 2001-ish period. So I've annotated 3 boxes at the top over here, which sort of shows a triple top. For technicians, we call them head and shoulders pattern. So you can see over here, I've also drawn a neckline, which is also, in other words, this uptrend line over here. You can see when this pattern sort of unfolds and when we get a bearish break below this uptrend line, that sort of flips the uptrend all the way into a huge downtrend. And the dollar index sort of moved from a high of 120 all the way to a low of 70. So what it's showing right now is that gold is experiencing some sort of a similar price action pattern again. So you can see a markup again, similar 3 tops over here shown by the rectangular boxes. And there is some sort of overhead resistance right now at around 103.50 level, as well as this 61.8% Fibonacci retracement level. So in terms of resistance wise, dollar index is facing some sort of a strong resistance over here. And moving forward, I think what we should look out for in terms of flipping price from the uptrend that we've seen since 2011 is once we get a bearish close below the uptrend line, which is currently hovering around 99 to 98 level. Once we get a monthly bearish close below that level, chances are that we could see the dollar index continue to suffer and the dollar index can continue to fall in the medium term to actually test this 93 range low again, and probably even flip down into a whole new downtrend like the one that we have seen back in 2001. And that is also in the backdrop of Donald Trump's big dollar policy rhetoric. So keep in mind, fundamentals wise as well as the chart wise showing some sort of the same pattern playing out. And with that sort of playing out, chances are that will provide enough tailwind for gold to actually head up higher again. And lastly, we just talk a little bit off tangent to gold. So for those who want to have sort of a leverage play on gold, we sort of recommend or suggest to look into the mining space. So what we have over here is the ETF on various miners. So we have the GDX, which is the big boys in terms of gold and silver mining companies, and GDXJ, which are basically the junior miners. And then lastly, we have the SILJ, which is sort of a silver pure play. So to illustrate what I mean by a leverage play on gold, you can see over here, since the upturn in 2016 first half, gold and silver appreciated 26% and 44% respectively during that period. However, if you were to look at the mining space, the miners actually performed way better than underlying themselves. So GDX was only up 116%, GDXJ was up 146%, and SILJ was up 222%. So you can see over here, the gold and silver beta in terms of comparison to the miners itself, during the upturn, the gold silver beta can easily hit a high of 3 to 5. However, keep in mind, obviously with higher return comes higher risk. So last year, second half of the year, we saw gold and silver actually experience some sort of a sell-off. Gold went down 15.8%, followed by silver at 17.9%. And obviously on the mining space, you can see the miners got whacked down pretty badly as well. So GDX was down 37%, GDXJ was down 42%, and SILJ was down 27%. So leverage play works on both sides, but something that we noted as well was that the gold silver beta on the downturn was actually way lesser than the gold beta on the upturn. So in the long run, I think this play should continue to sort of benefit traders if we were to believe that the current bull market in gold and silver is a circular one that's going to last for easily another 2 to 3 years. And to end it off, we just look at the price action chart of GDX, which are the big boys on the mining space. So GDX, GDXJ, and SILJ pretty much in the same kind of a price action chart. And you can see over here, what I've marked up is that particular bottom area over there. Gold actually formed a double bottom back in around 2015 December period. And once the double bottom is being broken out to the upside, you can see the mining space actually went into a whole new roaring bull market. So this is the point that I'm trying to put across. So this was double bottom that happened at a low of around 1262. And once we get the breakout over here, you can see GDX just went into a berserk uptrend, went up from a high of around 17 to a high of 31 within a short time span of, I think, around 6 months. And then only at the second half of the year, it went through some sub-selling off again. And we believe that the current price action is showing that the miners are sort of making a comeback over here due to the fact that they found some strong support of this 1881 level over here. And subsequently, the rebound was pretty strong. And this was the bullish post that we got above this downtrend line that signals that some sort of buying is returning to the market. And that is pretty much in line with what the underlying commodities are doing, gold and silver. So moving forward, we believe that the GDX as well as the other mining ETFs should continue to rise up higher within this uptrend, and price should continue to resume within this uptrend moving forward. And some near-term price action target for GDX will probably be the 25 level. Markup over here, and subsequently once we reach through this level, we can easily see 2870 and then followed by 3164 that we have seen back in June, July of last year. So to sum it up, for thesis on gold, we remain bearish on gold and silver. If I can sum it up in 4 points, they are based on the cyclical point of view. Because like I mentioned, gold is right now moving in a whole new circular bull market based on the AL cycle pattern, and based on other fundamentals such as rising inflationary pressures that we have shown, as well as rising uncertainties happening throughout the world, not just in the US but Europe. And last but not least, gold being a safe haven play when the next recession comes, shown by the rates actually Fed rising into weakness right now. So that by itself, I think we believe that 4 main points should actually drive gold and silver prices higher moving forward. And here are some of the instruments that you can use to capitalize on this circular bull market within the underlying commodities, gold and silver itself. So here we have SPDR Gold Trust, which is basically an ETF that tracks gold itself. And then we have SLV, which is the iShares Silver Trust, which basically tracks the underlying commodity silver itself. And then the 3 subsequent miners that we mentioned, GDX, GDXJ, and SILJ. And last but not least, we also have an initiation coverage on CNMC Gold Mine for those that want to be exposed to SGX listed stocks. And hence, with that, I've come to the end of my part. For the rest of the time, I'll pass on to Kang and talk about the trading note on NVIDIA.
Thanks, Jeremy. Okay, this Kang Wei here. I'm going to give a very short trading note on NVIDIA. For those who are not aware, we released our trading note last Tuesday around that period on the trading note on NVIDIA. We'll just do a very short one. Okay, so we initiated a trading note open position with an entry price of 106.22. The last traded was about 107.47, and we have a target price of about 120. The Bloomberg consensus target price is 119. Okay, if you're not familiar with NVIDIA, we'll just give a very short overview of the company. The company primarily makes GPUs, graphic processing units. Their core business in the past used to be in gaming products, so your graphics cards on your gaming products, etc., laptops, desktops, etc. And for a long time, primarily that was how they made their money. But recently, with the advancement of autonomous vehicles, VR technology, etc., NVIDIA has been expanding the use of their graphics cards to be implemented into these new technologies as well. And with that, I think that's caused a run up for NVIDIA to share price to go up quite significantly over the past 1 to 2 years. And while their revenue-wise, graphics cards for gaming tends to still be the bulk of their revenue. I would say easily close to about 90+% of their revenue still comes from graphics cards for games. A lot of the valuation of NVIDIA right now, the reason why it's run up so high is due to a lot of expectations on their non-core segments namely the autonomous vehicle, the VR technology, data centers, etc., etc. And so, a couple beginning of the year, their share price actually fell from the all-time high of close to 120, about 119 to about 90 plus before surging back up again to this 106 when we entered at our entry price. Reason being, I believe that one of their competitors, AMD, actually released a graphics card which was supposedly being able to compete with NVIDIA. But beyond that, I also feel that probably a lot of investors were taking profit due to the run-up in share price, especially since a lot of this run-up in share price is due to the expectation that a lot of their these experimental technologies will take off and they'll be able to reap a lot of benefit from these nascent technologies. So what happened recently though that caused them to run to reverse their downtrend and go back up, we believe, is because a couple of weeks ago, about a week before we released our trading note on NVIDIA, Intel actually acquired Mobileye. If you're not familiar, Mobileye is a autonomous driving vehicle company, or rather what they do is they primarily make the camera that was meant to be used in a lot of autonomous vehicles, and they actually paid a very high price for Mobileye. And Intel is also one of the competitors for NVIDIA, and they primarily make integrated graphics cards and chips. So the fact that Intel was willing to pay such a very high price for Mobileye lends legitimacy to the idea that graphics card, that chips, these computer chips can actually be very profitable to be used inside the future autonomous driving vehicles. And we believe that because of that, legitimacy that Intel's acquisition of Mobileye gave NVIDIA, that helped to reverse the downtrend and cause NVIDIA to go back up into the uptrend. If you're unaware, NVIDIA had previously in the previous CES show announced partnerships with Tesla, Audi, Bosch, Daimler, a lot of auto companies, and to put NVIDIA chips inside these their future autonomous vehicles. NVIDIA also announced their new Xavier chip, which has the potential to be superior to Intel's chips, which use the x86 architecture, whereas NVIDIA's Xavier chip uses an ARM architecture. I won't go into the specific details of the technology. If you want, you can go into our report, our trading note report, and read up more yourself. But suffice to say that for mobile devices, non like desktop devices, ARM architecture chips have been shown to be superior in performance as well as power consumption to x86 architecture chips. So there is a potential that despite NVIDIA's attempts to enter the space, despite Intel's attempts to enter the space, NVIDIA might have already surpassed them in terms of the technological superiority, which might indicate that the auto companies would prefer to continue working with NVIDIA. Besides the autonomous driving side, their core segment, gaming segment, also reported a 66% year-on-year increase to a record $1.35 billion in revenue for the quarter. And also they recently released their new graphics card, the 1080 Ti. So one thing to take note, however, is that the 1080 Ti has a similar performance to their previous release, which was a very high-end chip, and this they're selling this for quite a reduced pricing. I think in order to combat, like I mentioned, AMD's recent release for their graphics cards. So whether or not they are able to maintain their profit margins given the lower pricing of this graphics card remains to be seen. They have indicated confidence in being able to maintain the production at a reduced cost, but again, we'll need to take a look at the next quarter to see whether or not they are able to maintain that kind of operating and profit margins. But besides that, they also shown growth in other key segments. So the Quadro is the other chip that they are producing. It's meant for computer graphic designs. So primarily used in things like special effects for movies, etc. When the production companies use the computers to design all the special effects. I think it's a ongoing trend in a lot of movies now that more and more they're using a lot of CGI, and the graphics requirements will be quite intensive. And it's shown in their revenue increase. They grew 11% year on year. Besides that, they also mentioned that graphics cards revenue from data center has also tripled year on year. As more and more companies, big companies, start to see the benefit of putting in graphics cards, GPU units inside the server, inside their data center servers. The company quoted that Microsoft, Google, Facebook have all started to implement putting all these GPU units inside their data centers as well. So all in all, we feel that NVIDIA has been able to position itself very well to capture some of the fastest growing segments in the technological scene. If you're not familiar, we also last year released our video games non-rated note, which reported that the video games industry has grown to about close to $100 billion in revenue for the video games. Autonomous driving, self-driving vehicles are the next big thing in technology, and everybody wants to get into it. Besides that, cloud and data centers have also been shown to be growing and been driving a lot of technological growth. And so all in all, we feel that NVIDIA is very well positioned to take advantage of all these trends in technology. So we'll move on to technicals, and I'll pass on to Jeremy to talk a bit about the technicals for NVIDIA.
Thanks, Kong. So Jeremy here again speaking. So in terms of technical wise, this is the technical weekly chart on NVIDIA. So we can see over here, NVIDIA has been moving pretty nicely in a strong uptrend since 2015, last year, 2015, 2 years ago. And since then, you can see it's continued to break new highs of the new highs. And the most recent new highs that we have seen is around 120 level. That by itself, it's a huge psychological round number that I think buyers are still not ready to break yet. So you can see there was actually 2 attempts to break above this 120 level, but apparently it failed pretty badly, shown by the red bearish bar as well as the upper long shadow over there. So with that particular rejection of the 120 level, you can see NVIDIA sort of enters into a correction phase. But nonetheless, we believe that the current uptrend within NVIDIA is still sort of in place due to the fact whereby currently you can see the correction sort of gets halted pretty nicely off the confluence of 38.2 Fibonacci retracement level. That is based on this particular uptrend from this low point to this high point, as well as 2 other support areas from the 20 weekly moving average shown by the red line, as well as this particular resistance and support area around 95.20 level. So you can see since then, price sort of formed some sort of a bottom around this level, and our entry point base of this particular chart was last week, this bullish break last week of this particular pullback line over here. That was the price action that we were looking out for. So last week, I think end of week, this was what happened, and we got the bullish break, and we sort of came out with a trading note on I think Monday or Tuesday of last week. So you can then see since then price have come off the high of this particular bullish bar, and right now it's at around 107.47. So what we are seeing is the resumption of this particular uptrend since 2015, and we believe that with the uptrend right now sort of resurfacing, NVIDIA should continue to move within this uptrend and should at least easily target this prior all-time high again at 119.93 area. And hence with that, we've come to the end of today's webinar. So we'd like to open the floors to any questions right now if there is any. And in the meantime, if you are thinking of any questions, if you guys can help us with completing a survey to help us better benefit and improve our webinar, please do help us with the seminar or the survey that we have actually inputted in the chat box here. Thank you very much. I guess there's a question asking is gold price negatively correlated to the dollar strength? So you can see over here there isn't really a clear correlation between gold and dollar index itself. And what I mean by that is the correlation isn't fixed 100% of the time. And it depends on the particular environment that we are currently living in. So for instance, like this particular slide that's showing right now, like I mentioned again, if the Fed is actually entering into a rate hike cycle due to the fact whereby they are behind the curve and they are out there to chase inflation, chances are that rate hike cycle, due to the fact whereby they are chasing inflation, won't actually cause the dollar to strengthen all that much. And hence, during all this rate hike cycle that I've actually shown here, you can see the rate hike cycle actually sort of a benefit gold more than dollar index itself. So in terms of a correlation wise, there isn't really a clear correlation that we can pluck out from dollar index to gold, and it highly depends on the environment that we are living in. So for instance, where we are right now, this is the inflationary period that we believe that we are in again, due to the fact whereby we are way behind the inflation curve, shown by the Taylor rule spread again. So just to reiterate again, the most recent rate hike took the Fed 47 months of negative spread before they start chasing inflation. So we believe with the recent rate hike cycle that we have seen, that's the reason why gold is sort of benefiting so nicely, is because market participants are pricing in a higher inflation, and sort of inflation is taking precedence over the rate hike cycle, which is why the dollar index is also not strengthening at the same time. So keep in mind, be it whether the inflation is actually overwhelming the dollar strength, or the rate hike cycle is actually being forced by real economic growth, which we highly doubt that's currently showing the market. And the current rate hike cycle is definitely more of an inflation chasing game by the Fed. In terms of the question of the gold ETF, the 087, whether it's a good instrument to buy the ETF, in terms of liquidity wise, that is the SGX listed gold ETF. As compared to the one that is listed in the US, liquidity wise, definitely the one in US has higher liquidity. The ticker code is GLD. So in terms of liquidity wise, we would still sort of recommend to get into GLD rather than the one that's listed in SGX due to the liquidity issue. And other than that, it's pretty much the same because they track the underlying gold itself.
Okay, there's a question on how do I trade NVIDIA. So NVIDIA is a US listed stock on the NASDAQ. You might want to speak to your remisier or your dealer to get a account that is ready for US trading if you wish to trade US stocks. Yeah. Okay.
Hi, there's a question asking whether the ETF actually move in sync. So I'm assuming you're talking about the ETF, the one that I mentioned, the GX, GDXJ, and SILJ, whether they move in sync. So the short answer to this question is it again depends on the market condition. So usually most of the time, the miners themselves actually move in a larger move than the underlying commodities itself, gold and silver. So for instance, in a normal day, when we have a huge move, for example, a 1% move in gold and silver, you should expect the miners themselves, the GX, GDXJ, and SLJ to easily move up in the magnitude of 3 times or more. So like I mentioned just now, the gold beta during an upturn is definitely higher than the gold beta on a downturn. So during an upturn move whereby we see volatility coming into the market where the underlying gold and silver is sort of appreciating pretty nicely, 1 to 2% move, we should expect the miners to appreciate in the range of around 6% or more. In terms of whether they move in tandem, so GDX, GDXJ, and SILJ, they tend to move in the same particular fashion because the main factor is driven by underlying commodities itself, gold and silver. So whenever looking at the miners, I think the most important thing to look at again is the underlying commodities itself. So for instance, if you believe that gold and silver would continue to move in an upward kind of trajectory, then there's pretty much a high chance that GDX, GDXJ, and SILJ will follow path as opposed to what is happening within the underlying itself. Hi guys, sorry to trouble again. If possible, please do really help us with the survey so that we can collect valuable feedbacks to better improve our webinar. We actually put the link in the chat box, so please take some time again to fill up the webinar. Thank you very much. And in the meantime, if there's still any more questions, we are willing to answer all of them. Okay, if there's no more questions, we thank you guys again for tuning into today's webinar. See you guys next week, same time. Have a nice day.